Good afternoon, everyone. My name is Richard Ibarra, and I partner with Keri Lai. She's on the call as well. I'm a CFP, been doing this for about close to 30 years now. We manage a financial planning practice through Ameriprise, and we're actually based here out of Dallas, so about 70 degrees, overcast, pretty nice day. But it's a great day to be talking about inflation. I think it's a topic that's on a lot of people's mind. But first, I want to thank Savvy Ladies for allowing us this time to help provide some insights on the current state of inflation, interest rates, and we're also going to talk about ways to protect yourself through your investments. I've been actually serving with Savvy Ladies for the last few years. I've been able to help out several women with financial advice from items that are as simple as 401k allocation to life changes that affect them financially. One of my suggestions is just if you find anything that's relevant to you, I would write it down, and also you can ask questions as well. But like I said, our goal today is keep it about 20 minutes, 20, 30 minutes, but to give you some update on the inflation, answer questions and follow up. And we've done a lot of these in the past with small businesses, Fortune 100 companies. We found that one of the most effective ways to utilize this tool is to, if you do have questions and you don't feel comfortable asking in front of everyone, or they may be of personal in nature and need more detail, at the end of this, we'll have our contact information, and you can shoot us an email and we can set up a call, or you can shoot us an email with a question, and we'll answer those for you, just like we've been serving the last few years. That's kind of normally the way we do it. So I just wanted to provide that platform, that opportunity for you. So if you do have something, or you may think about it the next few days, just let us know. We'll be more than happy to answer those for you. Okay, so let's get started. So for myself, I am married. I have 4 kids. And, over the last few months, I usually, I tell clients to do a budget whenever we do financial planning, but I also do a budget for myself. And last month, I kind of was feeling like, hey, I feel like we're spending a lot of money on going out, restaurants, those type of things. And, when you have kids, sometimes you just don't want to make meals at home and you want to get stuff on the fly. So what I did was I pulled up my food, which combines of restaurant, groceries, fast food, all those things together. I compared it to March of 2021 to March of 2022. And when I looked at that food bill, it was actually doubled. Believe it or not, it actually has doubled over the last several months compared to what it was last year. So I think we all can empathize or feel what the price increase have done to our budget. So last week, for the first time I ever done this, was said, hey, my wife and I got on board and said, this week we're going to make a stringent attempt not to go out to eat to a restaurant, not to go to fast food, but everything's going to be done at home. And we usually do 90% of it anyway. But we were going to make a effort to do everything at home. Now, the only one that really felt the pain were our kids, and we felt the pain from their backlash. So, but we were able to make it through the week. And like I said, that was the first time we've ever really done something like that. And that was really just to say, hey, we need to get a handle on what's going on here. And if you ever think about, what was your first car you bought? Maybe in 1960, 70, 80, whatever year you were a teenager. In 1970, a new car was 6,000, 7,000. This year in 2022, it could be from 30 to 80,000, just depending on the car, if it's a Tesla or it's a more expensive car. But anyways, the price has increased, and that's inflation. And that's what we're feeling today through our gas prices, our food bills, is inflation. Inflation is price increase. And typically, what we look at as a economic and as a country is we like to have our inflation range between 2 to 2.5%. So meaning if something cost me $100 last year, maybe this year it's $102, right? So this year, the last inflation report, our next one's going to be tomorrow, but for last month, it was actually at 8%, believe it or not. So that's probably why we're feeling those hikes. We're at 8% inflation. The last time we were at this rate was 40 years ago. Around 1982, 1983, inflation was around 8%. But on the other hand, interest rates were very high too. So that kind of offset some of that. But as you know, over the last few years, interest rates have almost been at 0%. So with rates so low, we see an increase in home buying, car purchases, credit cards. In other words, there's been a lot of spending going on through the government giving stimulus to our through unemployment. Just a lot of money flowing in the economy the last 2 years. One from our government, but two on the COVID lockdown in 2020. Nobody was really spending money. And then last year, when they were kind of opened up a little bit more, people were getting out spending a lot of money. And with all that money being spent, it has pushed our inflation higher. Prices have gone higher just through that demand. So what we see is one question we had, and we get this all the time. Well, why is the Fed raising interest rates? Well, number one, interest rates have been 0% for a while. But two, they raise interest rates. Now, this is pretty important, is they raise interest rates to reel in or slow down the economy. So the Federal Reserve will use interest rates as either a gas pedal to stimulate the economy or a brake on the economy when needed. So with inflation running as high as they can, they raise interest rates to pump the brakes on the economy in an effort to get inflation under control. So think about this. So we've had 0% inflation, our 0% interest rates made it so cheap and easy to buy a house, to buy a car, to get a credit card. All these things, rates were so low. So now as they start to raise interest rates, it starts to slow down those home buying. It starts to slow down the car buying. You know, with the bottleneck of supplies too. I mean, it's hard to find a car or used car. But with the rates start to rise, people start to cut back on that consumption. And as the example I used earlier for my family, we also naturally start to reduce our consumption as well, just because prices are going higher. So with that being said, the expectation is that the 8% today will look like in December, they're estimating about 4.5%. So it does take a while for these to kick in. You know, the problem is if the Fed starts raising interest rates too quickly and dampens demand too much, it could slow down the economic recovery. So it's definitely a delicate balance in quarter look back. So if they raise the rates too fast, it could lead to higher unemployment if businesses stop hiring or even lay off workers to stay afloat. So if it costs me more money to get loans, to get business loans for my business, and I may not get as many business loans, and I may not expand as much, and through that I may have to lay off workers because of demand, just different types of situations. So it's a tricky balance they have to do. So far, though, you know, I have to say the positive part of the last three quarters, and what we typically watch as a practice, and I would write these down for sure, is that we see kind of turmoil overseas in the Ukraine. We see, you know, just things in our country with the high rates and unemployment. But at the end of the day, we're looking at unemployment, new job numbers. We're looking at company earnings. Those are really two big indicators. And over the last 3 months, new job numbers, even though there are a lot of that's people coming back to work from not working, but on the standpoint, they've been about 1.5 million in new jobs just over the last 3 months. And that's very positive. Like in March, it was 431,000. February, 678,000 new jobs. January, 450,000 new jobs. So very positive, and that's what we want to see. Because if in 2007, 2008, we were in that crisis where the housing bubble burst, and it was the reverse. It was negative 200,000 jobs, negative 400,000 jobs. So it was a weekly negative number, but they've been very positive, and we still continue to see that trend. But we are seeing the inflation, and really when I get gas and when I'm taking a long distance travel with my family, that's kind of like the here and now. Even though we want something to happen later down the road, I'm looking at the here and now. So we do see that coming. So it may take a little bit to see the impact of the raising the rates through the organic slowdown to lower inflation. So in the short term, we still may see higher prices. Hey, my food, they're raising interest rates, but my gas price of oil is dropping, but my gas price is still high, and the cost of food at a restaurant or at the grocery store is higher. So it does take a while for all that to marinate into reduce. So what we want to do is just kind of continue to monitor and watch what they're doing. So another thing that we were asked is a way to hedge against inflation is through our investments. And there are several ways to say, hey, I'm invested. The market's kind of acting funny over the last 3 or 4 months, dropping down. There's been inflation, interest rates. What are some ways I can protect myself and my finances that will help me out, help me and my family out? Because I understand there's inflation, interest rates are going higher. But at the end, I want to know what can I do for myself? So what Keri has just a slideshow she's going to show you guys kind of the top 3 things that we would recommend doing, getting your hands wrapped around, and see if these are some of the actions that you're taking today to help provide protection. Keri, you want to kind of go through those? I think you're muted.
Sorry about that.
Okay. Yeah.
Okay. Good afternoon, everybody. I'm Keri Lai, financial advisor with Ameriprise. Like Richard said, we work on a team. We've been together for 9 years now, and been in the field for a long time. So we put together a lot of workshops like this, big groups, small groups, and this is kind of like what we do, like Richard said. So if you guys have any questions on anything we talk about, feel free to send us an email. I have the information of our contact on all these slides, and if Tracy, if you need it, then we can always send you a copy of what we are sending out as well. But like I said, we just really appreciate you guys having on the call. So I want to switch gears a little. Richard kind of talked about inflation, talked about the federal interest rates, effects on the stock markets, but what does that mean for you as an individual, right? What does that mean? What do I need to do? So I kind of want to spend the next 5 to 10 minutes talking about how we can apply the information Richard just talked about into action items that we can take right now during times of volatility. So the first thing, I narrowed it down to 3 important steps that we can remember. So if you want to write these down, then feel free to, but I'll go through each one in more detail in the next few slides. So the first thing is don't panic. Keep your emotions in check. Secondly, be diversified. Ensure that your portfolio has the appropriate balance of equities and bonds. And lastly, review your goals and expectations. Make sure they're aligned with your financial strategy. So it's really just going back to the basics here and making sure that you're not overthinking it and trying to react to something that, it may not affect your portfolio in the long term. So first thing, don't panic, stay calm. When markets are uncertain, it's easy for people to, okay, you know what? The headlines on CNBC said that the market dropped 500 points, or there's the war in Ukraine, or now the federal interest rate is being raised. What does that mean for me? Maybe I should go ahead and sell out everything. But making changes during times like this is actually when you lock in a lot of losses and you reduce your upside potential. So we highly recommend you not do something like that. So we want to say be disciplined. If your investment strategy is well thought out, just stay the course, because down markets should actually be already accounted for in a good plan. If we sit with the client, we say, hey, what is your risk tolerance? What do you want? When do you want to retire? We actually account for these down markets. We say, okay, well, here's when things are going well, but what about when things are down? We need to make sure we diversify your portfolio. So that's already baked in there. So you only want to take out money that's needed for short term. If you have a plan in place, that's what your emergency fund is usually for. That's one of the first steps when you start a financial plan is to accumulate an emergency fund, roughly 6 to 12 months of expenses. This allows you to weather tough times like right now. So let's say the market's down and all of a sudden you say, I need $5,000, where are you going to pull it from? From one of your investments. And what that does is it locks in that loss. So if you had an emergency fund, that's what we say you pull that from, because that usually sits in, a checking or savings account. So main is don't panic and stay Here you see a chart. It just demonstrates what the Dow Jones on average did during declining periods of a short-term crisis. So if you look, everything goes down for most of the time. You have about a double-digit return within the next 12 months. So panic and you see the stock market go down and you move all your money to cash, you're probably more than likely out on the recovery side of it. And the goal of investing is always buy low, sell, right? But if you let your emotions lead you, what happens when the market drops? You panic, you sell everything, and then you wait on the sideline in cash. Then when you see the market rise and your friends tell you, hey, things are going good, you buy back, but you're already missed out on the recovery. So you basically done the opposite of what you should be doing. And what you did was you sold it at a low and you bought it back at a high. So that's why we always urge investors to stay invested. All right, second step is diversification. And I know I talk fast, so if I'm going too fast, slow me down. It's usually a quick talker. Second step is diversification. I think this one is probably the most important thing because in an environment of uncertainty and volatility, it's even more important to be diversified. You probably hear the term for diversification a lot. So what does that actually mean? It means having different types of investments in your portfolio so that you can reduce your overall risk. I have a family member who sees me lately. He asked me about the market. He's one of those who started buying stocks right around the time COVID hit. I don't know if you guys have a family who's done that, all of a sudden they're an expert, right? He thought he was so smart because everything he bought was going up. And so he would ask me, what should I do next? Hey, what stock should I buy? And what I tell him is consider selling off some of those individual stocks, take those gains and then diversify your portfolio. And of course, he'd argue that it's diversified because he has 30, 40 different positions. And so we went through the list one day and he had things like Tesla, PayPal, Snowflake, Netflix, things like that. And so he did well in 2020 and 2021, but in the past 4 months in 2022, some of his stocks fell 30%, 40%, or cut in half. And so his portfolio took a huge hit. And the reason is, even though you have all these different stocks in there, if they're all in the similar sectors, they're actually not going to offset each other whenever the market does go south. So, different sectors, different types, you want to make sure, like a good example of a diversified portfolio, let's just say a moderate allocation, you might have 65% stocks, 30% in bonds, 5% in cash or so. And then within those stocks, you might have large cap, mid cap, small cap. Okay. And then you have some growth, you have some value, maybe some blended. And that's why we say it needs to be diversified because different things work well in different markets. You don't want to have a 30, 40, 50% hit. If it's diversified, if you look through the history, maybe somebody who has a diversified portfolio might just be down 7, 8, 9, 10%, where some of these stocks are down 30, 40, 50%. Sorry, I was just skipping over that. Before you do put together your portfolio, though, I want to mention you need to determine your risk tolerance, right? For everybody. Some people, they're more willing to take on more risk, and some people are more risk averse. So you should see what makes you comfortable for the long term and all the different market conditions, not just whenever things are going well. Once you know what type of investor you are, then you can align the right mix for that. Portfolio is not only accounting for risk tolerance, but also your goals and your investment timeline. As a moderate investor who is about to retire next year and a moderate investor who is 25 years old, should have two very different allocations. And lastly, don't abandon diversification just because you're uncertain about the environment. It's tempting for people to move to what they call a safe asset like cash because you're unsure and you don't want to lose money. But in today's environment, like Richard said, it's 8% inflation. So cash is probably not really a good option for you. You're basically having a loss just with the effects of your purchasing power. So it's better to have a strategic portfolio that will help you manage risk in the downside. That would be your better approach. The last thing I want to mention about diversification is dollar cost averaging. So that's just a fancy way of saying, you're setting out regular intervals of where you're putting money into your investment. Think of 1K, right? That's probably what most of us save our money through. We put X percentage of our paycheck every week or every 2 weeks, however often you get paid. We put that in regularly. So sometimes the market's at a high, purchase less shares, and sometimes the market's at a low, we're able to purchase more shares. So over a longer period of time, dollar cost averaging can be really effective so that you can accumulate shares on an average cost. And actually, the positive side of the market volatility that you're seeing is that right now, the past 4 months, if you've been putting money in your 401k, you've actually been able to buy more shares because everything's at a low. You're kind of buying it on sale if you think of it that way, right? So for long-term investors, down markets can actually be beneficial if you're not needing to access any of these funds right now and actually take out your money. You're buying on sale. And us ladies, we like that, right? So the third step is just to review your goals and your expectations. Make sure you align your financial strategies with short and long-term goals. So you have a strategy and plan already, just make sure you reevaluate it with your advisor. And if you don't have it yet, right now would be a really good time to establish one. In your review with your advisor, make sure you're still on course to reach your goals. Make sure you have any changes that you need to update. And that needs to be addressed. And there are always changes, right? Maybe you lose your job unexpectedly. Maybe you decide, hey, when I retire, I want to move to a new city to be with my grandkids. The one we've been seeing trending lately is the Great Resignation, right? The big quit. People are just deciding, hey, I've had enough. I don't know if it's I don't know if it's market or what, but that's just what we're seeing. So that's something you feel, hey, you know what? I want to retire. I'm working, get into retirement already. Then that means a couple of things. It's either you're going to have to spend a little less in retirement and be okay with that, or you're going to have to save more. So there are ways to get to where you want to be. You just might have to set your expectations of how to get there. So all that's going to need to be updated on your plan. And then in your review, make sure you rebalance. So over time, when the market is up or down, your portfolio is always going to skew one way or another, right? So we talked about that moderate allocation, 65% stocks, 35% bonds. So, last 2 years, the equity side was probably going up. You might have seen that maybe now your portfolio is 80% in stocks because it was just gaining so much, all your gains, all your reinvestments. So now you're taking on more risk. You want to scale that back and you want to rebalance. And what that just means is you're selling those highs, like we talked about, and then you're buying back at the lows. So you're just now readjusting. So you're taking an appropriate amount of risk. And a lot of our 401ks, they actually have just a rebalance button. Like you can actually go in your settings and click rebalance. Some of it do it quarterly, some of it do it annually, but that way you set it up and you don't have to remember, hey, I need to rebalance every quarter or so it's going to do it for you. So that gets really helpful and it makes sure that you're always in line. So once you're done with all this, just really stick to the plan, because if you have a plan in place and you're diversified, these short-term volatilities, they really shouldn't affect the long-term outlook. So it just depends on what your focus is going to be. So those last 3 steps are things you should always remember in a volatile market, going back to basics. Like I said, these last 2 slides, I just wanted to add them in as a reminder of steps that you should be taking all the time, because you never know when an unexpected event might occur. So just kind of a couple of things that to think about is you want to make sure your affairs are all in order. Things like beneficiary designations, power of attorney, last will and testament, healthcare directives. So all that needs to be updated, because not only is it when you originally put in who you want, things change in your life, like we talked about before. So you might have to have somebody else listed, especially that beneficiary designations. Again, past 2 years, it's just been strange, right? And we've had a lot of clients with family members that passed away, some unexpectedly. And when they go through their estate settlement, some of them said, okay, well, I thought XYZ is supposed to be the person listed, and it's not. And what people make the mistake with most of the time is that they think that whatever's in their will dictate who gets paid out. But that's not true for certain types of accounts. Accounts that have beneficiary designations, you actually have to list somebody, and that is who's going to pay out. So like your 401k, your IRAs, you could even do it on your checking and savings account. You could put a TOD on there and have whoever you want take over it. And that will not be determined by your will. So this actually supersedes your will. So if you something happened and you changed and you forgot to go back and change your 401k, but you said I updated my will, that's not going to matter. The 401k companies can say who's listed here, even if it's an ex-spouse or somebody, that's the person who's going to take your money. So, you just want to make sure all that's up to date and taken care of. And of course, power of attorney, especially these last 3, power of attorney, last will, and testament, and the healthcare directives. As you get older, you want to make sure that's in order, because you don't know when things are going to happen, and you want to make sure the right people are making the choices for you. So this last slide, I'm actually going to turn it back over to Richard for this, because he's kind of the expert on our team with life insurance, disability, and long-term care. So he's going to want to touch on this to go over with you as well. So Richard, I'll let you take this one. Or he's not.
Can you hear me now?
Yes, you're on mute again.
Yeah, it's been a while since I've done a Zoom call. We usually do Teams, or we're actually starting to get in person. So finally, hey, but thanks a lot. So a couple of takeaways I just got from that, and I feel that's pretty important. Is we talk about inflation and all that, but I can assure you the last 3 months, the number one question that we get from clients is, should I sell out of the market? Do I need to get out? It's like, when we're up making a lot of money, the last few years, you're up 20% or whatever that number is. Nobody wants to sell. And the reason why is because making money feels good, but losing money, the fear of losing money overweights the how good it feels to make money. So there's a panic mode that gets in there. So investing is very emotional. It's a very emotional topic. But like Keri said, diversification. So we always remind clients, hey, remember, we pre-planned for this. Diversification is the key to taking emotion out of your investing. Diversification is the key to taking emotion out of your investing. If you're diversified and you have a good mix of assets, it does take away from panicking, wanting to get out of the market. It keeps emotions in check. The only time I see really folks get in trouble is if they own one or two stocks and the stocks are down, and then you really feel it. So just be aware of that. And the reason why we wanted to bring this up, and I'm going to just go over really quick with you guys, but in the last year, this has been a very big topic just because of COVID. Number one is life insurance. You may see people on Facebook or your social media accounts that have GoFundMe accounts that for family members or friends. And it's very tragic, but a good way to prevent that, if we have a company that has benefits, make sure you're taking care of all their benefits. Like a lot of times they'll offer you life insurance and they'll offer you supplemental life insurance at a very inexpensive rate. Make sure you take advantage of that. And like Keri said, make sure you have the right beneficiaries on there too. But I can assure you that the last couple of years, life insurance has been a very big topic and very important, because we can talk about planning all day long, but if something happens tomorrow, you need to have some type of insurance to protect yourself. And out of all the life insurance, if you need outside, term insurance is the least cost of all life insurance. Disability income, if you become disabled while you're working, it does pay your income for you, about 60% of your wage. It will pay directly to you while you're not able to work, the short term and long term. Too much to get into detail right now, but like we said, if you have additional questions afterwards, feel free to email us. And then third, most important, is long-term care. Usually people ask us, when should they start to think about long-term care insurance? Well, usually the sweet spot for long-term is age 55 to 70. The younger you are, the least amount of cost, and you can sometimes lock that in. It can go up, but it does protect you for assisted living and all that. And we usually say this is the last insurance you're going to need, because it really protects your assets from being wind down if you needed some type of long-term or nursing care assistance. So that being said, that's us for today. And once again, thank you everybody for being on the line and just being proactive, trying to get information about your own financial situation. Really taking control of your situation is the best way to combat some of these fears. If we do have them, but also just kind of maybe some of them are, this is new information, and a lot of it could be just reminders. So it's always good to have a reminder. But we want to thank Savvy Ladies and their organization. What a great organization, and definitely making a difference. I can tell each time I talk to somebody, it really has been impactful, and it's been impactful for us too. And as I mentioned earlier, I encourage whomever would like to have additional questions, just feel free to shoot us an email, and we'll do the best we can to help you out with that. But we do appreciate your time and taking some time out of your lunch or your day. If there's anything else, or if there's questions, we'll stay on the line maybe for another 5 or 10 minutes to answer those.
All right. If anybody has any questions, feel free to unmute yourself, or you can put them in the chat.
In the meantime, I'm just going to put up Richard's information right there in case anybody needed it, his email address, and then our website in case you needed to reach out to him.
I think everybody's still taking notes from what we
Yeah.
talked about. Like I said, that's okay if you don't have any, but if you do think of some later, or if they're like if personal nature, just feel free to send us an email or call back to Tracy or some of the ladies, and they'll connect us as well.
Yeah, we get that a lot in our workshops. I guess some people have stuff, and it's kind of private. They talk about certain things, and so sometimes they just want to ask afterwards.
I'm going to go ahead and put our helpline back into the chat for anybody who might have missed it. And thank you so much, Richard and Keri, for doing this for us. Great information. I learned a lot. I'm sure everyone here learned a lot. So we appreciate your time. And it doesn't look like we have any questions. So I'm going to go ahead and stop the recording. And